Good morning everyone, this is Charalambos Pissouros, Senior Analyst at IronFX, bringing you the morning comment for the 21st of September. Bank of Japan opts for a new strategy. The Bank of Japan maintained its negative interest rates unchanged, but it changed its policy framework following the results of its comprehensive policy review on the existing measures. The bank decided to abandon its monetary base target and instead introduced a QQE with yield curve control policy. The new policy framework will consist of two major components. First is the control of short-term and long-term interest rates to step up its inflation battle, and the second is inflation overshooting commitment. The latter commits the bank to expand its monetary base until it achieves price stability above 2%, which means that the monetary base target, previously increasing by 80 trillion yen per year, could now fluctuate in the short term. As for the first component, the bank aims to steepen the country's yield curve and set to keep the 10-year interest rate around zero. So far, Japanese equities seem to have liked the new policy, with Nikkei and TOPIX indices both rallying following the decision, while the yen reversed its initial gains and tumbled across the board. Even though in the short run the speculative long yen position unwinding may continue for a while, we would like to sound a note of caution for further weakness ahead of the FOMC meeting later in the day. As for the longer term, we would like to see inflation expectations rising before trusting a broader yen weakness. Later in the day, the torch will be passed to the Fed, where the committee is widely expected to keep its rate hike powder dry. Slowing jobs growth in August, lackluster retail sales, a flat core PCE rate, as well as the collapse in both of the ISM PMIs, have taken a hike at this meeting of the table in our view. What's more, the latest signals from various FOMC members have been conflicting, to say the least, suggesting that a consensus to raise rates is unlikely to be reached. As such, the focus will turn to the updated dot plot, the new economic forecasts, and Chair Yellen's press conference following the meeting. We expect officials to revise down the median dot for this year to signal only one rate hike. We consider it likely that the longer-term rate path will be revised down as well to reflect a lower neutral interest rate in line with the latest Fed signals from Williams and even Chair Yellen at Jackson Hole. We don't expect any major revisions to any of the economic forecasts, with the only exception being 2016 economic growth, which may be revised lower due to the disappointing Q2 GDP print. As for Yellen's remarks, we expect her to emphasize that although the Fed is on hold for now, a hike may soon be warranted, thereby using this meeting as a stepping stone to prepare investors for a possible rate increase later this year. With September out of the game, December is increasingly looking as the most likely candidate for such a move. We assign a much lower probability to a November action, considering that the US presidential election almost coincides with the FOMC meeting, and that period could be marked by heightened market uncertainty. As for the indicators, Norway's unemployment rate for July is forecast to have remained unchanged. Canada's wholesale trade for July is also coming out. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX, wishing you solid trading.